Hello, I'm Jonathan Zimpelman, Wealth Advisor with Axis Wealth Planning. Welcome to our November 2025 market review. If you don't follow the markets closely, that's okay. Over the next several minutes, I'm going to walk you through what happened to the stock and bond market last month, why things moved the way they did, and what might lie ahead in December. November was a mixed month for U.S. stocks. Broadly speaking, equity struggled, dragged down by volatility, investor concerns, and some pressure on high-flying stocks. The broad U.S. equity market sold off in the month with a bit of recovery in the last week. Stocks that had led the run-up earlier in the year, especially technology and AI-related names, saw some of the greatest decreases. The decline was not across the board, though. High-growth tech-heavy names dropped, but some more broadly diversified stocks increased. Outside the U.S., many international and emerging market stocks held up relatively well in comparison. In fact, for 2025 overall, non-U.S. equities have been among some of the strongest performers, helping diversify return opportunities globally. What drove this uneven performance? Well, here are three factors. Many of the names that had run up earlier in the year on hopes about artificial intelligence and future growth started to look expensive. That spurred some profit-taking. Investor sentiment grew more cautious as macroeconomic uncertainty remained. Some saw less clarity around the outlook for interest rates, inflation, and economic growth, largely because of the government shutdown. At the same time, underlying fundamentals like corporate earnings and economic resilience remained a reason not to give up on equities entirely, which helps explain why many non-tech and international markets stood their ground. Meanwhile, the bond market saw some interesting developments in November, and for many investors, it's just as important as what happens in stocks. The yields on U.S. Treasury securities moved somewhat downward, but overall stayed in a recent range. For instance, the 10-year Treasury yield ended the month around 4.01% after some modest short-term volatility. The yield curve showed signs of slight steepening. While short-term yields moved down a bit, the longer-term yields held up and actually edged a little bit higher. Bond funds overall had a mixed month, but high-quality investment-grade bonds held up better than the low-quality ones, and the demand remained steady for short-duration bonds and municipals as investors sought stability amid equity volatility. So why did this happen? The main driver is interest rate expectations. With the likelihood rising that the Federal Reserve may cut rates in the near future, they meet in the middle of December. Investors pushed into bonds. They stabilized prices, which keeps the yields in check. At the same time, some economic uncertainty with the slower growth indicators and softer inflation added to the demand for the relative safety of treasuries amid high-quality bonds. Looking beyond the numbers, November's market behavior was shaped by a few broader themes. As the quarter's earnings rolled in and economic data added clarity, many investors appeared to settle back in, though not without reservations. The reduced macroeconomic noise allowed some to focus more on fundamentals again. As tech and growth stocks cooled, other regions, particularly outside the U.S. and other sectors, including value and quality-oriented stocks, got some renewed attention. And with bond yields stabilizing and interest rate expectations shifting, bonds, especially high-quality ones, became an attractive alternative for investors seeking that lower volatility and steady income. So as we head into December, there are several key factors that will influence how the markets behave. Interest rate policy from the Fed. They meet in the middle of December, and much depends on what the Fed decides to do. Many investors are betting on a rate cut soon, and that could boost both bonds by pushing yields lower and equities by making borrowing cheaper. It's important to note, though, that many times when the rate change is announced at the end of the meeting, that's not as important as their future intentions of rate increases or decreases. So let's pay attention to the future intentions. Earnings and economic data clarity is also very important. As more companies report and economic data flows out following the government shutdown, investors are going to get a clear picture of whether the economic soft landing scenario is holding up or if trouble lies ahead. There's also a rotation away from tech and concentration risk. If investors begin to shift away from those high valuation, high volatility growth stocks, especially those AI ones, toward more broadly diversified portfolios, which is value, quality, dividend-paying companies, we could see a broader market rally, less dependent on a few big names. If yields remain or rise from these current levels, bond investments may become more attractive, which could actually temper how much money flows into equities. That could impact how aggressive some investors want to be with their stock allocations. What does all this mean for you? Whether you're fully invested, conservatively positioned, or somewhere in between? It underscores the value of diversification, not putting all of your eggs in a few high-flying stocks, spreading across sectors, regions, and asset classes, equities, bonds, international. It also highlights that bonds and fixed income still matter. They are not dead. In fact, given current yields, interest rate expectations, bonds can offer a relatively stable home for capital if equities get rocky. It reminds us that markets can be volatile, especially when valuations are high and sentiment shifts. Volatility also brings opportunity for those with long-term horizons and a well-thought-out plan. And finally, keep an eye on policy, economic data, and corporate earnings. This will likely shape how the rest of 2025 ends and 2026 begins. At Access Wealth Planning, we believe in balancing opportunity and risk, making sure your investments are aligned with your long-term goals, not just chasing headlines. Thanks for joining me for this November review. We will be back soon with more updates. And as always, we're here if you want to talk through this, how this environment should influence your personal financial strategy. Thanks for watching.